Lamba, Director, Lamcon Finance and Management Services, joins us with his take on how Indian companies can follow best practices to avoid such kind of rumor mongering as well as a perception impact from investors at large. Anil, it's great to have you on this show. First, highlight the problem as you see it.
So far as the balance sheet is concerned, I find the biggest area of concern is when companies use short-term funds for long-term purposes. Now, if you study the balance sheets of most SIC organizations, you will find this has been the reason for it. Every builder today in this low real estate market who's in trouble is precisely because short-term money was used for long-term purposes. So I think one of the first red flags that the balance sheet throws up, one must check whether this has been happening. And this is pretty easy to check because in a balance sheet, if you look at the liability side, which represents sources, we can bring them down to two numbers. The share capital, the reserves, the long-term loans can be clubbed together as long-term funds, and the current liabilities represent short-term money. And on the asset side, your fixed assets, your non-current assets are long-term and the current assets are short-term. All one has to see is make sure the long-term sources are greater than long-term users, which automatically means some of the long-term money has been used for acquiring current assets in addition to fixed assets. So I think this being the most important thing to be seen in a balance sheet, especially by a layperson.
How critical is it to check on current and liquid ratios when understanding and try to read balance sheets, especially for smaller companies, in order to not burn your fingers like most people have had in the last 3 months when it comes to some of the mid and the small cap companies in the market?
So equally important because in a way related. Current ratios represent the liquidity of the organization, and an organization having a negative working capital, which means if their current liabilities are greater than current assets, these companies are not in a position to meet the short-term liabilities. And this precisely happens when the long-term sources are lesser than long-term users, which means some of your long-term assets have been funded from short-term sources. So if your current ratio is positive, which means on the asset side, look at the number of current assets, the figure of current assets. On the liability side, look at current liabilities. The current assets should be higher than that. Norm is the ratio should be 2:1. Even 1.5:1 need not be a cause of worry. But more important is the liquidity ratio, which means from current assets. The whole logic of current ratio is what? If people are standing on your doorstep saying, can I have my money back? These are the short-term liabilities. At that point of time, you must have assets on the other side of your balance sheet where you can go knocking on their doors saying, can I have my money back so I can pay my short-term liabilities? And this is represented by current assets. But all current assets cannot be liquidated on demand because a component of current assets is what is known as inventory. Again, taking the example of real estate people, builders, they may have huge amounts of unsold flats right now. But if they need money tomorrow, they can't pick up a phone and say, I want to sell this flat. They may not find a buyer for months together. So if you ignore inventory from current assets, what is left is called liquid assets or quick assets. And the ratio between quick assets and current liabilities should be minimum 1:1. And obviously, if your current ratio is positive, it automatically means the company is using long-term money for long-term purposes. So these two things are very important.
Thanks for highlighting that. I think that's a very, very interesting point. Add to that, so you've established the first two red flags. We have about 5 more to go. You're saying operating profit graph must be an ascending one. And I think many people tend to overlook this because, they say, oh, we're going through a bit of a transition phase, rising input costs, can't manage that. So highlight for us how critical it is for this indicator to work, because it's really about, enhancing the efficiency with which the company is managing its cost base.
Absolutely. Most organizations work out profit levels. They work out the gross profit and the net profit. And I am of the opinion you should work it out at 3 levels: gross profit, operating profit and net profit. And I think more important than net profit is operating profit. I call it the semi-bottom line. There's a bottom line and there's a semi-bottom line. And semi-bottom line is more important than the bottom line. If you plot a graph, I think the gross profit graph should be linear to the sales graph, at least, which is a good enough thing. Your operating profit and net profit graph should be converging. The reason for that is by the time you reach these two numbers of profit, you have not only deducted your variable costs, but you also deducted your fixed costs. And fixed costs do not increase, definitely not in proportion. And therefore, the net profit growth as a percentage should be greater than the percentage of growth in sales. And the reason I emphasize more on operating profit is net profit could be a result of your operations as well as your non-operating activities. And it's no fun if a company is making profit because they're selling properties. If they're making motor cars, then it is important that the profit comes by making and selling motor cars and not by selling land or something. And therefore, operating profit, I think, is relatively more important than net profit.
Very quickly, because we're running out of time, I want to touch upon, and if you could just concise and give our viewers some of the other criteria that you follow for sizing up businesses. I can see how you're saying should have positive operating and free cash flows. I think that's also explained in the answer that you just highlighted. Gross profit and sales must rise in the same proportion. Again, something you said that there needs to be a linear move in both of them and perhaps a one-on-one correlation. So that's established. Net profit should increase at a higher percentage. What happens with that, Anil, is that a lot of the times that higher percentage comes on the back of other income. So, how do you explain what this red flag means?
Fair enough. Which is why if you look at operating expenses, you cannot take into account income. And because by the time you arrive at operating profit, from gross profit, if you minus fixed costs, you arrive at the operating profit. And since fixed costs haven't gone up in proportion, the percentage of profit should go exponentially. So if your sales has gone up 20%, gross profit should go up 20%, and net profit should go up at a percentage higher than that, even operating profit. But for net profit, I completely agree with you. That could be a result of selling off important assets which they need, but just because they want to show a profit, that might have happened.
And then lastly, just to close in on the 7 parameters that everyone should look at when tracking a balance sheet, and especially so when it comes to smaller size companies, would be the financial leverage parameters that a balance sheet is running on. Explain to our viewers how critical a point is this.
Yeah, it's a topic which needs much more time than what you're giving me. And I think it's a most misunderstood or less understood point. People use leverages in such a narrow way that, companies that borrow more, highly leveraged companies, and that's about the extent to which they discuss. But leverages are a result of fixed costs. And leverage denotes that exponential increase in profit due to a certain increase in sales. And operating leverages are a result of operating fixed costs. Financial leverages are caused by financial fixed costs. And therefore, companies that borrow more have high leverages because their interest component is high, which is a fixed cost. Therefore, it leads to high leverages. And if one calculates these two leverage multiples, I'm sure I'm not doing justice to this answer, but if you work it out, I think all companies can be classified into 4 types. If you write down the operating leverage multiple and a financial leverage multiple, possibility number 1, the company may have a high operating leverage and a high financial leverage multiple. Possibility number 2, it could be low and low. Possibility 3, high, low. Possibility 4, low and high. Now, what is high, what is low is a debatable point. I can tell you what is low. A leverage multiple of 1 is low because it just means linear. I think a leverage multiple of 3 is high. If you have an operating leverage multiple of 3 and a financial multiple of 3, it means the combined multiple is 9, which means for a 100% jump in sales, there will be a 900% jump in profit. For a 10% jump in sales, there'll be a 90% jump in profit. Nobody will complain. But if the sales falls by 10%, there'll be a 90% fall in profit, which can kill companies. So having said that, 1 is low and 3 is high, one reaches one's own conclusion. I think old economies companies, because operating leverage is not in your control. Operating fixed costs are dictated by the nature of activity. So those who have high operating leverages should keep their borrowings under check and try and keep financial leverages low, which means expansion should be funded preferably by equity rather than by debt. And those who have high operating, companies having high operating leverages should keep financial leverages under check. Companies having low operating leverages can afford to borrow. So old economy companies usually have low operating leverages. But IT companies, hotels, airlines, which have huge operating fixed costs, that means to break even, they need to function at a certain minimum level. And such companies, if they borrow more and they have a high operating and a high financial leverage, I think this is probably the biggest red flag that you can come across. But this needs some little calculation at the back end. You will make phenomenal profits in such companies when the going is good. But at the first sign of recession, these are the companies that will fold up the fastest. And therefore, if one does buy into such companies, then you must watch the market like a hawk after that. And at the first sign of trouble, you should get out. But companies which have both low will have very sluggish growth. Operating leverage is low, financial leverage is low. I think one should stay away from them. You'll make more money by giving them fixed deposit rather than the shares. So I do justice to this.
Anil, it's been so insightful speaking to you, getting a better sense of the red flags in reading a balance sheet and a P&L account. Thanks very much for joining in.